There's a massive opportunity that most investors are missing out on. It's a market that represents over 80% of the world's population, and it's growing at twice the rate of developed nations. Today we're going to dive into emerging markets and why not having them in your portfolio could be leaving some serious money on the table. So for the sake of time, let's dive right into it. Welcome back, current listeners, and welcome to all you new listeners of the Wealth Decisions podcast, where we talk about crucial wealth decisions and mindset hacks to help you live a richer life. Before we dive in, I would love it if you hit the subscribe button or whatever channel you're on, and leave a review if you're enjoying the show. Your support really helps me refine the podcast, make it better, and reach more people. Today we're going to dive into something that might be the missing piece of your investment portfolio, and that's emerging markets. And this is something you're going to want to pay attention to. Let's just start with a quick definition. Emerging markets are economies that are in the process of rapid growth and industrialization. It's kind of like going back in time and looking at where the U.S. was, 40 years ago. Think about countries like India, Brazil, Indonesia, and Vietnam. These aren't the established, powerhouses like the U.S., Japan, or Germany, but they're on their way up. Now, here's why emerging markets should be a part of your portfolio. First, emerging markets account for about 40% of global GDP. But they typically kind of make up about less than 10% of most investors' portfolio. And in fact, a lot of investors have 0% exposure. And so that's kind of a huge disconnect. Second, these markets often move differently from developed markets, which means they can provide really valuable diversification. When the U.S. market is going up and down or has a period of flat returns, emerging markets can add extra protection and give you some diversification that potentially could give you growth during a period where the U.S. is underperforming. Now, let me just give you a hypothetical example. Imagine just two investors. Investor A has a traditional 60-40 split between the U.S. stocks and bonds. But investor B has that same basic structure but allocates about 15% to emerging markets, reducing their U.S. exposure accordingly to that, just in the equity part of their portfolio. And during a period when U.S. markets are struggling, for instance, with high interest rates, investor B might benefit from growth in countries like India, which is experiencing a manufacturing boom and a growing middle class. Now, this doesn't mean that emerging markets will always outperform. In fact, when you look back at asset class returns from 2010 through 2024, emerging markets was only the top asset class once, but they had 4 times where they were in the top 3. I know when I bring up emerging markets to clients, it sounds like a risky proposition. I know some of you think that emerging markets are riskier, and they definitely can be more volatile than developed markets. But remember, risk and reward often go hand in hand. Plus, there's always ways to manage risk. Last week, I talked about developed markets and how they're one of the best performing asset classes year to date. Well, emerging markets is second or third in that race. Emerging markets are up about 6% year to date. So if you have some exposure to emerging markets, when the U.S. market is struggling or going sideways or even going down, you might benefit from having some emerging markets in your portfolio. But how do you do that? Now, I always suggest an approach of starting small. You don't need to go all in. Even just a 5% allocation can make a pretty meaningful difference. Most financial advisors suggest anywhere from 5 to 10% of your portfolio be exposed to emerging markets. Another way to get exposure to emerging markets is just to use diversified ETFs. Certainly don't try to pick individual stocks. It's really tough to keep up on emerging market companies, and many of them aren't even listed on the U.S. stock exchanges. So use a broad-based emerging market ETF and spread your risk across multiple countries and companies. And obviously take the long-term view. Emerging markets can be volatile in the short term, but their growth potential becomes very apparent over long periods of time. And they're a great diversifier for a portfolio. You're investing in economies that are growing sometimes double or triple what the United States is. So let's just look at another example. Think about the smartphone revolution. 20 years ago, most people in emerging markets didn't even have a mobile phone. Today, countries like India have leapfrogged traditional, banking infrastructure to become leaders in mobile payments. Companies serving these markets have seen tremendous growth. And this is just one example of how emerging markets can maybe surprise us with their ability to, adapt and innovate. They're not just following the developed world's playbook, they're writing their own. There's multitudes of opportunities in the emerging markets. If you're not investing in emerging markets, you're missing out on a big chunk of the opportunities in the world. So let me just highlight some emerging market companies that you may have heard of, maybe you haven't. For instance, in India, a company called Reliance Industries. They transformed the oil and petrochemical company into a digital services powerhouse through its Jio platform. In just a few years, Jio brought affordable internet to hundreds of millions of Indians and is now expanding into everything from retail to financial services. In Latin America, there's a company called Mercado Libre. It's become known as the Amazon of Latin America. But they kind of have an innovative twist. They built Mercado Pago, which is a payment system that started as a way just to facilitate transactions in the marketplace. And now they're one of the leading fintech platforms. In Southeast Asia, there's a company called Sea Limited that operates Shopee. It's the region's leading e-commerce platform, along with the digital services arm. And they've managed to build this super app ecosystem that caters specifically to Southeast Asian consumers. So these are just some examples. Brazil has a company called WEG that's become a global leader in electric motors and industrial equipment. And these companies aren't just copying these Western business models. They're creating solutions designed for emerging market challenges. And they're solving problems we don't even have in developed markets or finding efficient ways to deliver services. Now let's just address an important question that I get quite a bit. When people ask, what is emerging markets? I say it's economies like India and Brazil. But a lot of people wonder, where does China fit in? Is China a developed market or is it an emerging market? Technically, most index providers like MSCI still classify China as an emerging market. We know that they're the world's second largest economy. They have advanced industries in electric vehicles, solar panels, digital payments. But yet their per capita income still kind of remains below, developed nations. So some investors now treat China as a separate allocation entirely. They're not fully developed, but they're not the typical emerging markets. It's kind of in a category of its own. So in your portfolio strategy, you might want to think about having developed markets, like we talked about last week, the US, Europe, and Japan. China maybe as its own allocation, and then emerging markets excluding China. And this will give you really broad diversification in the world. And this approach kind of gives you more control over your exposure to different stories and risk factors. So what should you do with this information? Here are some concrete steps you can take. Number one, review your current exposure. Pull up your investment statements and check to see if you have any emerging market exposure. If you have target date funds in your 401k that you use predominantly for the money that goes into your 401k, some of those target date funds do have some allocation to emerging markets. And I found by reviewing clients' 401ks, there's usually not an individual option in your 401k for emerging markets. It's usually a broad-based international fund. But many broad-based international funds will have some exposure to international. So look at that international fund, pull up the profile sheet, and find out how much exposure that particular fund has in emerging markets. And look specifically at whether you have a separate China exposure or if it's bundled with other, emerging markets. Number two, consider your ETF options. In your IRA, Roth IRA, or taxable investment account, there's some great low-cost ETFs out there. Vanguard has one, iShares has a good emerging markets fund, and Schwab has a great emerging markets equity ETF. For more target exposure, you might explore looking at some China-based ETFs. Crane Shares has a China ETF, and if you wanted exposure to India, iShares has a great one, and Global X has a Vietnam ETF. Just remember to compare the expense ratios and holdings before investing. Number three, consider active management. There are certain parts of the market where active money management can add some value. I talk a lot about passive investment strategies or using ETFs to get exposure to different parts of the market. But emerging markets might be one area where active management can add some value. So research some of the active mutual funds on the emerging market side and make sure their expense ratios are reasonable. Expense ratios on active mutual funds typically are anywhere from 0.4 all the way up to about 1.5. And you have to really go look at whether, if you're paying 1.5% for a mutual fund, whether it has a track record of outperforming significantly. Number four, think about sector exposure. Different emerging markets have different sector strengths. For example, Taiwan and South Korea are strong in technology, while Brazil and Russia are a little bit more commodity heavy. Make sure your emerging market allocation aligns with your overall sector strategy, if that's something you're focused on. And number five, create some type of implementation plan. If you decide to add emerging market exposure, consider dollar cost averaging your way in over the next 3 to 6 months rather than investing all at once. This can really help reduce the impact of market timing and volatility that can be more pronounced in emerging markets. I talked about how emerging markets is up year to date. I think that is a long-term trend where emerging markets is going to do pretty well over the next 3 to 5 years. So having some exposure there is going to help, I think, your returns over the next 3 to 5 years. But past performance is no guarantee of future results. But I do believe international developed markets and emerging markets are positioned really well and should be part of your portfolio. Just always remember the global economy is changing all the time, and your portfolio should reflect these changes. You don't need to make dramatic moves, but just thoughtfully incorporating some emerging markets in your portfolio can help you position your investment strategy for the future. So that's it for today's episode. Do you own emerging markets? Would love if you pre-ordered my new book, Momentous Decisions, 7 Steps to Better Health, More Wealth, and a Richer Life. This has been a long lifetime goal of mine to put out a book. It's everything I've learned about habit change, health, wealth, and life, all wrapped up in one book with a 7-step plan to help you live a life closer to exceptional. If you'd like to pick up a copy of the book, you can go to momentouswealthadvisors.com/book, and at the bottom of that page there'll be a pre-order link, and it'll be out sometime in early August. And if you like this episode, please rate the episode, make some comments, and hit the notification bell to get updated on future Wealth Decision podcasts. And please, if you could, share it with a family member or a friend. My goal with the Wealth Decisions podcast is to reach over 100,000 people by the end of the year in the Twin Cities and beyond, so that people can make better wealth decisions to live a richer life. If you'd like to schedule a discovery call with me, you can go to my website at momentouswealthadvisors.com. And I'll spend some time to get to know you a little bit and find out if I might be able to steer you in the right direction or help you with your financial future. And once again, thanks for listening and have a great weekend.